It begins with a contradiction so deep and so normalized that most Americans never question it. The United States claims to be the land of economic opportunity, yet decade after decade, wealth concentrates into fewer hands with mathematical precision. The mystery isn't just how this happens, but why the systems meant to create fairness end up reinforcing inequality. The answer is hidden in the invisible machinery of American finance, a set of institutions and policies that shape wealth far more than effort, talent, or hard work ever could. People are told that success depends on individual choices, ambition, and discipline. But behind that comforting narrative lies a more unsettling reality. The real engine of American wealth is designed, regulated, and preserved by institutions that operate far outside the public spotlight. These institutions, whether central banks, policy committees, rating agencies, or financial giants, do not merely participate in the economy. They set the rules by which everyone else must play. To understand how U.S. wealth became so concentrated at the top, we must return to the early 20th century, a time when America was still struggling to find financial stability. The Panic of 1907 nearly toppled the entire banking system, and while newspapers blamed speculators and reckless investors, the true consequence was political desperation. Congress quietly turned to a small circle of powerful bankers who, away from public scrutiny, drafted the blueprint for the Federal Reserve on Jekyll Island. When the Federal Reserve was created in 1913, the official story promised stability and fairness. But the unofficial outcome was the birth of an institution with the power to expand or contract money itself, an ability that would shape wealth distribution for generations. In the 1920s, its loose credit fueled a booming market. When it tightened, the boom collapsed. The crash of 1929 was not just a market failure, but a revelation of how a single institution could tilt the entire economy. In the aftermath, reforms were introduced. But each reform still placed more authority in the hands of centralized institutions. The Securities and Exchange Commission, the FDIC, and other regulatory bodies were supposed to protect ordinary Americans. Yet over time they became intertwined with the very financial entities they oversaw. The Great Depression didn't just reshape policy, it revealed the pattern that would define American wealth for the next century. Crisis leads to intervention, and intervention leads to consolidation. After World War II, America emerged with unprecedented global financial dominance. With two-thirds of the world's gold reserves, the U.S. created a system where global currencies tied their value to the dollar. The Bretton Woods framework was presented as an architecture for world stability. But hidden within it was a powerful truth. The U.S. could influence global markets simply by controlling the supply, demand, and trust in its own currency. This influence began to magnify wealth concentration at home. International capital flowed into American banks, American corporations, and American investments. The U.S. elite gained access to global capital markets, while the average American remained tied to wages. The difference in opportunity widened, but the system's complexity kept the public unaware of the forces at play. By 1971, the pressure mounted. Foreign nations no longer trusted the U.S. to redeem dollars for gold, and President Nixon severed the link entirely. The dollar became a fiat currency backed only by belief and the institutional systems behind it. With this single move, the U.S. gained the ultimate tool, the ability to create money without physical limits. But the benefits did not flow evenly. Monetary expansion, increased asset values, stocks, real estate, corporate holdings, all of which were already disproportionately owned by America's wealthiest wages, however, were left behind. The invisible system had begun to reveal its true function. Asset owners prosper when money is created. Workers do not. The 1980s accelerated this trend with aggressive deregulation. Wall Street rode a wave of innovation derivatives, leveraged buyouts, high-frequency trading that multiplied wealth for those at the top. Complexity became a currency of its own, favoring institutions with the resources to understand and exploit it. Ordinary Americans were told these innovations made markets more efficient. In reality, they made the system less transparent and power more concentrated. By the 1990s, globalization fused with America's financial dominance. Corporations moved manufacturing overseas, cutting labor costs while boosting profits. Shareholders benefited. Workers were left with stagnant wages. Meanwhile, Institutions like the IMF and World Bank spread U.S. economic policies worldwide, ensuring that global markets operated under systems the U.S. elite understood and controlled. Then came 2008, the moment when the invisible systems revealed themselves fully. The housing collapse wiped out trillions in household wealth. Yet the institutions responsible were rescued by the very government that preached free markets. The Federal Reserve provided secret loans exceeding $16 trillion to banks, ensuring corporate survival while millions of families lost their homes. Inequality didn't just grow, it exploded. After the crisis, something paradoxical happened. Instead of weakening financial power, the crisis strengthened it. Banks grew larger through mergers. The Federal Reserve became more central to the entire global economy. Interest rates fell to near zero, inflating stocks and real estate to historic highs, assets overwhelmingly owned by the top 10%. The rich gained trillions. The middle class recovered slowly. The poor lost ground entirely. Throughout the 2010s, the concentration continued. 3 credit rating agencies determined how expensive borrowing would be for nations, corporations, and individuals. 3 major index funds, BlackRock, Vanguard, and State Street quietly came to control significant stakes in nearly every major U.S. company. A handful of tech firms amassed more data than governments. The system wasn't broken. It was operating exactly as designed. Then came 2020. The pandemic triggered the fastest market crash in modern history, followed by the fastest recovery ever recorded. The reason was simple. The Federal Reserve created an unprecedented wave of money, equal to nearly 20% of all dollars ever produced. Stocks surged, while unemployment hit record highs. Billionaires gained over $1 trillion in 1 year. Small businesses disappeared, and the public realized something uncomfortable. Markets were no longer responding to economic reality, but to institutional decisions. Inflation followed, and while the public blamed supply chains, the deeper cause was structural. When money creation boosts assets more than wages, the rich become richer, and everyone else pays the price through higher costs of living. The invisible system protects capital, but transfers risk downward. Attempts at reform consistently failed. Campaign finance rules allowed financial giants to influence legislation. Lobbyists shaped tax laws that favored wealth preservation. Proposals to break up megabanks stalled. Even moments of public outrage led to minimal structural change. The system's architecture was too entrenched, its beneficiaries too powerful, and its complexity too effective at hiding responsibility. By the early 2020s, the pattern became impossible to ignore. The top 1% of Americans held more wealth than the bottom 90%. 3 banks controlled nearly half of all deposits. 5 tech companies dominated digital infrastructure. And while millions struggled with rising rent, healthcare costs, and debt, asset markets continued climbing as though insulated from real-world conditions. Today, the mechanisms that keep U.S. wealth concentrated at the top are not dramatic or explosive. They are subtle, legal, and systemic. Monetary policy that inflates assets. Tax structures that reward capital over labor. Global financial networks built around the dollar. Corporate concentrations that swallow competition. Algorithmic systems that reinforce existing financial hierarchies. And through it all, institutions that present their decisions as technical, neutral, or inevitable. Here lies the mystery from the beginning. Why would a nation that promotes equality rely on systems that consistently produce inequality? The answer is both simple and unsettling. These systems were created to prevent economic collapse, not to ensure fairness. But in preventing collapse, they channeled power toward those with assets, influence, and access power that compounds over time. The U.S. economy did not become unequal by accident. It became unequal by design, by a series of decisions made in response to crises, by institutions meant to stabilize markets, and by policies that favored holders of capital over earners of wages. Whether this system can hold is an open question. The national debt is rising. Interest costs are ballooning, and political divisions deepen economic instability. Global trust in the dollar remains strong, but alternatives are emerging. The institutions that once seemed invincible are facing new scrutiny, yet their influence over markets remains intact. The first key takeaway is that America's wealth concentration is structural, not personal. Hard work alone cannot overcome systems designed to reward capital. The second is that crises consistently shift more power to elite institutions rather than less. And the third is that inequality is not just a domestic issue but a global consequence of American financial architecture. The future of the U.S.-led world economy will depend on whether these hidden systems continue operating unchecked, or whether transparency and reform can reshape how wealth is distributed. But one thing is clear: understanding these invisible mechanisms is no longer optional. If you found this breakdown revealing, stay connected and explore more of the stories shaping our economic future, because the systems that define wealth today will decide opportunity for generations